Trying to buy your first home in Toronto or the GTA in 2026? Here's what everyone keeps saying. You need a 20% down payment. You need a perfect credit score. You need to wait for the market to hit rock bottom. And all of that is mostly wrong. Now, 2026 is actually one of the better times that we've seen to buy a home since 2019. The chaos of 2021 and 2022, that's over. 20 offers on every house, that's gone. Sellers refuse conditions, not anymore. But here's the real question. Do you actually know how much you need saved, what you can afford, and what not to skip when buying your first home? In the next 15 minutes, give or take, I'm gonna walk you through the complete first-time home buyer roadmap for Toronto and the GTA. From credit scores to closing day. No fluff, no theory, just the exact process I walk my clients through every single week. You'll learn the actual minimum down payment needed, not the 20% myth. A government rebate worth up to $8,475 that most buyers don't even know exists. The exact accounts that you need to maximize your down payment savings, and why the mortgage stress test actually means you'll qualify for less than you think. Now, my name's Odane Harding, and I'm a realtor here in Toronto, and I've helped dozens of buyers get into homes across Scarborough, Pickering, Ajax, and beyond. And if you're seriously considering buying a home, I do free buyer consultations where we go through a realistic budget, a realistic timeline, all the way through to what showings look like and getting you into your first home. I'll leave my calendar link in the description where you can book a time with me and we'll go through it. Before we talk about houses, mortgages, and due diligence, we need to talk about something first, and that's your credit score. Because if this number is not where it needs to be, everything else is theoretical. Now, comment below, what's your credit score? Is it under 600? I mean, if it's under 600, you might not comment. Is it 600 to 680? Is it 680 to 740? Is it 740 plus? Or you have no idea and you're scared to check. I'm just curious to see where you're at. And if you do have a low credit score, I can make a video on how to improve that. But here's what the lenders actually care about. If you're 680 or higher, you're in good shape to get a mortgage approval. If you're 740 and above, you're golden. You'll qualify for the best rates. Lenders pretty much love you. Below 680, you're not out of the game, but you might face a higher interest rate and you might need a higher down payment. And I've worked with a lot of buyers between the 650 and 680 range who did get approved. Now, if you're below 600, we need to have a different conversation. You're gonna need 6 to 12 months of just rebuilding your credit so that you can be mortgage approval ready. The good news is your credit score isn't permanent. Here's how to improve it. Pay your bills on time, every time. Set automatic payments up if you have to. One missed payment can drop your score 50 to 100 points. Keep your credit utilization below 30%. If your limit is 10K, for example, it means that you don't carry a balance more than $3,000 at any given time. And for the love of everything, don't go apply for 5 credit cards before you go get approved for a mortgage. Your future self will thank you. And if you follow this QR code pinned somewhere, I'll give you my one-pager on how to rebuild and repair your credit. I've seen buyers improve their credit score from 640 to 720 in a few short months, just by paying credit cards and fixing errors on their credit report. It's very doable, you just need a plan. All right, now let's talk about where to save for your down payment to maximize every dollar. And look, I know we're in an expensive part of the country, and some of you may have financial assistance from parents and grandparents, but this section is for those that need to save all or part of the down payment on their own. And the first home savings account is where you start, period. The Canadian government actually did something useful. They created an account specifically engineered for first-time homebuyers with some serious tax advantages. And here's what makes the first home savings account so powerful. It combines the tax benefits of an RRSP with the tax-free withdrawal magic of a tax-free savings account. You get to deduct your contributions from your taxable income, like an RRSP, and then you get to withdraw that money when you're buying your first house, tax-free, like a tax-free savings account. Both sides of the equation are working in your favor. Now, whenever it comes to tax benefits, there's always limits. And the limit on this account is $8,000 contribution per year to a maximum of $40,000 saved. And if you have a partner or a spouse, you can each open up an account separately and double your contribution room from $40,000 to $80,000 when it's combined. And if you haven't opened a first home savings account, stop what you're doing right now and run straight to the bank and open one. Every month you wait is a month you're losing out on your tax advantages. The second weapon you have in your arsenal is the RRSP Home Buyers Plan. And if you don't know what an RRSP is, it's a Registered Retirement Savings Plan. Now, the Registered Retirement Savings Plan is the Canadian government's way of encouraging retirement savings through tax advantages. But there's a special provision called the Home Buyers Plan. And the Home Buyers Plan allows you to borrow from your RRSP for your down payment. You can withdraw up to $60,000 tax-free individually, or $120,000 combined as a couple. And yes, I did say borrow this money because you have to put it back in your account. You have 15 years to pay it back, which is pretty doable, but it's an interest-free loan from yourself. And that in itself is pretty powerful. Between the First Home Savings Account and the RRSP Home Buyers Plan, you can access between $40,000 and $200,000 for your down payment with serious tax advantages. Now, how do you actually save without living on ramen all the time? Automated. Set up automatic transfers for the day after you get paid. Treat your savings like a bill that you can't skip, almost like a subscription. Put windfalls, tax refunds, work bonuses, and that extra $50 your grandma gave you straight into your savings account. And maybe skip the $8 oat milk lattes. I said what I said. Now, let's destroy the myth that's probably holding you back. So, if you think that you need a 20% down payment to buy a home in Canada, you're completely wrong. That myth needs to die. And I'm gonna kill it right now. Here's how minimum down payments actually work. For the first $500,000 of a home, you need 5% down. Meaning, if you're buying a home for $500,000 or less, you only need 5%. Now, yes, we're in Toronto, in the GTA, so finding a home for $500,000 is few and far between, but they are out there. Now, if you're buying a home more expensive than that, anything over $500,000 to $1.5 million, you need to put a 10% down payment. So, for example, if you're buying a $900,000 house, you need to put down 5% of the first $500,000, which is $25,000, and then on the remaining $400,000 that's left, you need to put 10% down, which is $40,000. When you add the two together, that's $25,000 plus $40,000 for a total of $65,000 in down payment that you'll need. And if you don't think $900,000 can go a long way, let me give you some examples. You can get a downtown Toronto spot in the tip-top lofts. You can get a detached side split in Scarborough, or you can get a 3-bedroom house in Pickering or Ajax. Now, if you go over 1.5 million, now you need to put 20% down. Now, can you imagine on this $900,000 house, you thinking that you need a $180,000, 20%, instead of $65,000? You see the difference? That myth would have cost you $115,000 in unnecessary savings anxiety. You're welcome. So we covered where you can save for your down payment and how much you actually need for your minimum down payment. But where does the rest of the money come from? And the answer to that is your mortgage. And to qualify for a mortgage in Ontario, we need 4 things. Good credit, you see why we started with that? A stable income, a solid down payment, and manageable debt. Simple enough, right? Not exactly, because banks also make you pass something that we call the stress test. It's the lender basically asking, if interest rates go up, can you still afford your mortgage? So the lender wants to make sure that you can handle a 5.25% interest rate on your mortgage, or whatever interest rate you're getting, plus 2%, whichever is higher. Because apparently, qualifying for the rate that you're actually gonna get is too easy. But to be honest, this has saved a lot of people because rates have gone up on existing mortgages, and in some cases, this has protected people. In some cases, their mortgage has gone up so much that they can no longer afford it. So this is actually a safeguard for you. Lenders are also gonna look at 2 ratios, your gross debt service, or GDS, and your total debt service, TDS. And your gross debt service is your housing costs versus your income. And this needs to be under 39%. And total debt service is where they look at all of your debts versus your income. And that ratio needs to be under 44%. Now, the most commonly known mortgages in Ontario are fixed and variable. Fixed mortgages lock in your interest rate and your payment for the entire term. No surprises, no drama, and it's your safest bet for when rates are expected to rise. Because who wants their monthly payment to jump around giving you anxiety? When we had super high inflation, that's what a lot of us felt. We had multiple rate increases month after month after month. And watching the Bank of Canada announce their interest rate, it was like a spectacle. Everybody was involved, everybody was watching, because so many people took variable interest rates. And every time the bank announced an increase, it affected them. And that's some anxiety I would not want you to have. Now, the inflationary environment is much different now. We're more stable. So the Bank of Canada actually came down with their interest rates, and it hasn't bounced around much. It's pretty stable, but who knows what's gonna happen. Now, variable rates fluctuate with the lender's prime rate. When rates drop, you save money, but when they go up, you spend more because your payments go up. It can basically be a financial roller coaster. The upside, there are lower penalties when you break your mortgage, or if you pay it off, or you refinance. And there are potential savings when the rate is steady. So which one should you choose? And there's no one size fits all answer. It depends on your income stability, your risk tolerance, and your timeline. When you buy, are you planning to move within the next 2 or 3 years? And the more deeper question you should ask yourself is, am I the type that likes to know exactly how much I'm paying every month? And if that's you, I'd offer the fixed rate. Now, if you're somebody that can handle a little bit of financial risk and you like gambling a little bit, go variable, because it might work for you. And if you're looking to move in the next 2 or 3 years, you'd probably want to go on variable, because when you pay off your mortgage, the penalty would be much lower. Now picture this, you test drive a brand new luxury car for a month. Heated seats, premium sound, all the bells and whistles. You fall in love. Then the dealership shows up, takes the keys away, and hands you keys to a new car, a 2003 beater, bad brakes. Now that's what house hunting can feel like if you don't know your budget. Don't be that person, seriously. In fact, I won't even let you. Before we go on showings, you have to talk to a mortgage advisor so that you have your number, so that you know what you can actually afford. And if you don't have a mortgage broker, hit me up. I can put you in touch with some really good ones. Now there's 2 ways of getting your number. There's pre-qualification and there's pre-approval. And they sound similar and it's very confusing. So let me break that down. The pre-qualification is the casual version. You give the lender some basic information about your income, your assets, and your debts. And it can usually be done online or on the phone. They run a soft credit check, which doesn't hurt your score, and they give you a rough estimate of how much you can afford. Minimal documentation, quick and easy. And it's great for when you're browsing online, but it might not be accurate. And a mortgage pre-approval is where the mortgage broker digs in deep. They want your income, they want your assets, they want your debts, they want your credit report. They run a hard credit check this time, which will affect your score a little bit. And you'll actually need to submit documentation. So T4s, notice of assessments, recent pay stubs, the whole package. When it's done, you get written documentation about how much you can actually afford. And this is what gives you credibility when you're making offers. One caveat to that, if you're buying a $1 million house, and let's say you have a $200,000 down payment, you need about $800,000 in mortgage financing to close your house. Now, if this house is appraised at $950,000 and not the million that you actually agreed to, then we have problems. Now, this $50,000 shortfall that this home did not get appraised for at full price, you'll have to make up the difference, because the bank will not lend you to $1 million. They will only lend you to the $950,000 that it appraised for. So don't go gung-ho when you get a mortgage pre-approval either, because the home still has to be appraised at the right value. And that's where I'll come in to double check and ensure that you don't spend too much money on a home. In fact, in this market, my goal is to have you spend less than market value. So talk to a mortgage advisor, get pre-approved, know your budget, and then we'll go house hunting. So you found a house that you love, your offer's been accepted. Congratulations, time to celebrate, right? Not quite. We have to do our due diligence. Now, this is a really important step, and we have to make sure we get it done so that you are protected. The first thing that we do, especially in this environment, is make sure your offer has conditions. We will proceed conditional on a satisfactory home inspection. Another one is we will proceed only after satisfactory mortgage approval. So let's go through a home inspection. So you will hire a house inspector to essentially come to the house and metaphorically lift up the hood and make sure everything is running smoothly. They'll check the foundation, the heating and ventilation and air conditioning, plumbing. Basically, they're looking for anything that could bankrupt you. Is it required? No. Should you skip it to save money? Absolutely not. It's the best few $100s that you can spend in this process. It's almost like an insurance policy. Unless you would enjoy some special surprises with some big price tags. Then for satisfactory mortgage approval, we want to take this exact home, send it to your mortgage broker, and have them review and do a check to make sure that this home will appraise. And if it does, then we're fine to move forward. If it doesn't, we can either try to renegotiate to a lower price or we can back out of the deal. Other due diligence that we might have to do is if the home has a septic system, we'll have to do a septic inspection. That can go between $300 and $500. If it has a well, we can do well water testing. That's between $200 and $400. And if you have big plans for this property and you want to know the exact lot lines for what you may potentially build, then we need a surveyor. And that costs between $1,000 and $2,000. Also, when you're buying a condo, you're not just buying the unit. You're also buying into a corporation, the condo corporation. And you need to know if that corporation is financially healthy or if it's a disaster waiting to happen. And in this case, the status certificate is your Bible. This legal document shows you everything about the condo corporation, financial statements, the reserve fund balance, planned repairs, any pending lawsuits, the rules, and what other owners owe in unpaid maintenance payments. Your lawyer reviews this, and it could cost between $100 and $300. And some lawyers will give you a credit on the legal fee if you actually close this transaction with them. But it's important that you understand what's in it, so either ask your lawyer to give you a report or read through it yourself. The red flags that I watch for are low reserve fund, and this is money set aside for major repairs like the elevators, the roof, the water heating system, things like that, because those are really expensive. If the reserve fund is underfunded and they need $2 million to handle a major repair, every owner gets hit with a special assessment, which is they're coming to you for money. It could be $500, it could be $10,000. It could even be more than that. So imagine you have to deal with your mortgage, your utilities, your maintenance fee, and then out of nowhere, they're just like, hey, we need this $10,000 so that we can fix the roof. We didn't put enough money in the reserve fund. That's why your maintenance fees were so low for this time. So we need this roof fixed, and yeah, we need that $10,000. That can be catastrophic. And we do our best to make sure that doesn't happen to you. Because I've heard of first-time home buyers who buy a condo and 6 months later, they're hit. And they're hit because these things were not explained to them. So now I know for a fact that's not you. Red flag number 2 is maintenance fees jumping. If condo fees were increased 10% over the last year, that's a warning sign. So we're gonna have to ask why that is. Red flag number 3 is pending or ongoing legal litigation. If the condo board is being sued, we need to understand why that is. Is it a lawsuit over a construction defect? It could also be a one-off, like a slip and fall. But we need to know what type of lawsuits are happening because it could affect your unit as well. And red flag number 4 is not necessarily a red flag. It just depends on what you're planning to do with your condo. And that is rental restrictions. Some condos restrict the amount of units that they have up for rental. And if you're planning to buy this condo to live in for a while and then rent it out after year 3, this restriction may prevent that. On the flip side, it could be a good thing if you're looking at living there and to retain the condo values, because generally speaking, they say that homeowners take care of the condo better than renters do, because renters are just in and out. They don't care as much. They leave the place messy, things of that nature. All right, so let's talk about the cash that you actually need beyond your down payment, because there's a dangerous myth that once you've saved for your down payment, you're good to go. And you're pretty close because that is the biggest component of it, but there's still a little more to go. Now here's a complete picture of what you'll spend from offer acceptance to the day you move in. Before you firm up and drop the conditions from the agreement, we have the home inspection, $400 to $700. If necessary, a septic inspection, $300 to $500. If necessary, well water testing, between $200 and $400. And again, if necessary, the property survey between $1,000 and $2,000. Now on closing day, we have legal fees, estimated at around $1,500 to $2,000. Land transfer tax. Think of it as the government saying, congratulations on buying a home. Now pay us for it. Land transfer tax is a one-time fee that you pay when ownership of a property transfers into your name. It's due on closing day, and it's based on the purchase price of your home. So the more expensive your home, the higher the tax. Now where it gets spicy is that in Ontario, you pay the Ontario land transfer tax. and that's it. But if you buy inside the city of Toronto, you pay Ontario land transfer tax and you pay Toronto land transfer tax. So buyers in Toronto are actually paying land transfer tax twice. And that difference can be $10,000 to $25,000 depending on price. The good news is that as a first-time home buyer, there is some relief because you get rebates. In Ontario, that rebate is $4,000. So if your land transfer tax is $4,000 or less, it means you don't pay anything. And if it's higher, $4,000 gets knocked off. Now, Toronto also offers a land transfer tax rebate, and that's $4,475. So if you're buying in Toronto and you qualify as a first-time home buyer, you could receive $4,000 from the Ontario government and $4,475 from Toronto for a total of $8,475 in tax rebates. And that's real money. The key takeaway is that land transfer tax is one of the biggest expenses when it comes to your closing costs. And it's one of the main reasons why buying in Durham, York, or Peel can sometimes feel more affordable. Because outside of Toronto, you're not paying double land transfer tax. So before you shop, you need to know where you're buying, what taxes apply, and what rebates you qualify for. And that's why I tell first-time home buyers, it's not just about affording the home, it's about affording closing day. Title insurance, around $600 and up, depending on how much coverage you'd like. Property tax adjustments, which varies, and it's where you're basically reimbursing the seller for paying the taxes beyond them living there. And an appraisal fee if the lender requires, and that can be between $300 and $500. If you're getting movers or a truck rental, you're looking at between $500 and $2,000 plus. And if you're moving and your friends are helping you, you gotta provide the pizza, beer, and the wings, and that's between $100 and $300. And then all the small things that you didn't realize you needed, like shower curtains, tools to assemble your furniture, lawnmower, and shovel. So the total additional cash you need between 1.5% to 4% of the home's purchase price. So on a $700,000 home, that's between $10,500 and $28,000 on top of your down payment. But if you don't budget for this upfront, you're gonna be scrambling in the last hours trying to find $15,000 to $20,000. And that's a terrible position to be in. When we work together, I'll give you a complete closing cost estimate so that you know exactly how much you need and there's zero surprises. Now, I know I spent a good deal talking about money, 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 but there's actually good news. The Toronto and GTA market has been the most balanced that it's been in years, and that's great for first-time home buyers. Prices have come down, interest rates are down, and affordability is a lot better. We're seeing way more homes on the market than we did in 2022, giving you more options, and that means you're not stuck between looking at overpriced listings and choosing between a small segment of homes. You actually have time to think and compare and not panic buy. And don't get me wrong, good priced homes in nice areas are still getting bidding wars, but it's fewer and far between. And it's definitely not the frenzy that it once was. And the biggest change is that sellers are accepting conditional offers again, meaning that you can protect yourself before locking into a home. So if you've been sitting on the sidelines, waiting for things to cool down, waiting for a chance to really negotiate and protect yourself, this is it. This is the market that you've been waiting for. But this window, it's probably not gonna stay open forever. As I've mentioned, I've already seen bidding wars come back on good homes in good neighborhoods. If it drops even further, we're most likely gonna see more buyers jump back into the market. That will most likely drive prices back up. So the people who buy now in this balanced market, with actual conditions and negotiating power, they're gonna look like geniuses in 2 to 3 years. All right, I know I've thrown a lot at you. So let me distill it down to your next few steps. If you think you're 6 to 12 months away from buying, check your credit score and fix any issues now. Open a first home savings account immediately. Set up automatic savings transfers. Start researching neighborhoods. Talk to a mortgage broker and get pre-approved. Even if this is premature, at least you'll have a starting point and you'll know where you need to get to. Save aggressively for a down payment and closing costs. You can start looking at homes online, and if you have the time, go out to see a few open houses so you can understand the market a little bit. And if you're like, hey, I already did all that, then book a consultation with me. That way I can understand what you're looking for, set up a customized home search for you, and we can start looking at homes. Again, my link is in the description. The biggest mistake I see are people that are financially ready and they're sitting on the sidelines waiting for a miracle, like a housing market crash. The truth is, the perfect time doesn't exist, and this market is not going to wait for you. So if you're financially ready, meaning you have good credit, your down payment saved, and you have stable income, then you're ready. And buying your first home in Toronto or the GTA is definitely doable in 2026. It's also more complex than it's ever been. You need someone in your corner that actually knows this market, not someone who's gonna show you homes that you can't afford or pressure you into something that you're not ready to buy. And the more I can educate, the less people get taken advantage of. So if you got value from this video, if I cleared up any confusion, destroyed some myths, or changed your timeline for buying, do me a favor. Hit that like button, subscribe if you want some more information, and share this with anyone who's thinking of buying a home in Toronto or the GTA. Looking forward to seeing you on a call or in the comments. Let's get you into your first home.